Hello everyone, this is Phil Yeager, and I want to welcome you to Module 11D in Financial Accounting, and this is pensions. Now, what we're going to talk about first is the determination of pension expense. And we're going to see that we are talking about defined benefit pension plans. Now, there's another type called a defined contribution plan. A defined contribution plan is like a 401k. That's where the employer will say, I will contribute 10% of your salary each year towards your pension. And you as an employee will have an account, and every quarter, usually it's every quarter or monthly or yearly, you'll get a statement from your employer showing how much is in your pension expense account. Now that's called a defined contribution plan. Defined contribution plan. It doesn't require an actuary to calculate the expense for the employer. Now, if we need an actuary to calculate the expense, it is called a defined benefit plan. A defined benefit plan. Now, what is a defined benefit plan? This is where the employee comes to you, the employer, and says, when I retire, I want to retire with $80,000 a year. Now, in order to determine the annual pension expense, an actuary has to figure out what are the 5 components of pension expense that you, the employer, will need so that when that employee retires, that employee can take out $90,000 a year in pension benefits. So please remember, FASB 158, which replaced FASB 87 on the bottom page 395, right, deals with defined benefit pension plans. Now, it says in the paragraph on the bottom, determination of pension expense. Pension expense is a net amount calculated by adding 5 factors. These factors are service cost, the interest on the projected benefit obligation, and I will explain this terminology to you, the expected return on plan assets, amortization of unrecognized prior service cost, and the effects of gains and losses. Now, please note that in pension accounting, we have 2 types of accounts. We have the actuary's accounts, which have nothing to do with the financial statements. And then we have the financial statement accounts, like pension expense, accrued pension liability. So any accounts that appear on the financial statements are financial statement accounts. Now, if we have pension accounts that do not appear on the financial statements, but are just kept by the actuary, they are called the actuary's accounts. Now, the first one is A, on the bottom, the service cost. Now remember, we're going to come up with calculation of pension expense. Now, the service cost account is an actuary account. It is not a financial statement account. But the question is, how does it affect your pension expense? Well, it says here on the bottom of page 395, it increases your pension expense. Now, what does the actuary do? The actuary figures out how much of expense, all right, is part of the pension expense that you are giving credit to your employee for the current year of service. For every year the employee works, you give them credit towards their pension expense. In other words, you give them credit towards their pension benefit when they retire. Now let's read what it says here. Service cost is defined as the actuarial present value of benefits attributable by the pension benefit formula to the employee service during the current period. FASB 87 requires that future salary levels be taken into consideration in this calculation. So when the actuary calculates what the current year's service cost is for that employee, please note the actuary determines that that service cost component of pension expense is based on the employee's future salary levels. So what we're really doing here is, all right, if I work for you. You're going to give me 1 year of credit because I worked this year. You're going to give me 1 year of credit towards my pension. Now, the actuary is going to determine how much that 1 year of credit is in actuarial terms. And the actuary will base that on not just what I'm making today, but it'll be based on future salary levels. All right? Now, the service cost increases pension expense. And they're going to ask you to calculate pension expense. So therefore, they're going to give you the service cost. Now, you may have to search for it, but they'll give it to you. All right. Now, the next thing, interest on the projected benefit obligation. This increases the expense. Now, the projected benefit obligation is an actuarial account. It is not a financial statement account. It's not going to appear on the financial statement. Now, let me explain to you what it is. Let's assume that all my employees came to me today and said, we want to cash out of the pension plan, which means we want all of the benefits paid to us today. Now, I would go to the actuary and say, actuary, figure out how much I would owe my employees today if they all cashed out. And by the way, when you do that, please base what I owe them today on future salary levels. So the projected benefit obligation, when you figure out what you owe your employees today, it's based on future salary levels. So what the actuary did to come up with it was to take the present value of these future benefits that I will owe my employee. Now, each year, by the way, that would be the beginning PBO. Now, as long as my employees did not cash out, right, the beginning PBO increases each year. Now, what makes it increase? Well, how did we calculate the beginning PBO in the first place? Because remember, we have to calculate what we would have to pay our employees if they all cashed out today based on future salary levels. So therefore, all right, if they don't cash out, which would make the assumption they won't, that projected benefit obligation is going to increase each year. Now, when we calculate the PBO, all right, we use present value, which means the beginning PBO has no interest in it. Right? We took it out. So therefore, as it starts going into the future and increasing, the thing that's going to increase it is the interest component, because the opposite of present value, that's what we figure out to come up with what we would owe the employees today. Right? They all cashed out. That's actually the present value of the PBO. All right? But every year now, the PBO is going to increase because of interest. That's the reverse of present value. It's compounding. All right? Now, you have to add interest each year to come up with the current pension expense. Now, let's look at what it says here. The interest on the projected benefit obligation is defined as the increase in the amount of the projected benefit obligation due to the passage of time. Since the pension plan's obligation at the beginning of the year is stated in terms of present value, I told you that, a provision for interest is required. By the end of the period, the plan's obligation will increase by the amount of the interest that would accrue based on the discount or settlement rate selected. Now, the discount rate selected should be determined by reference to market conditions using such rates as the return on high-quality investments or an implicit rate of return in retirement annuities as a basis for comparison. So basically, all right, the actuary will tell you the interest rate. Now, they give an example here. Sometimes they will ask you to compute the interest component to add to pension expense. Now, how do you compute the interest component? First of all, what you do is you take the beginning projected benefit obligation. Let's assume the beginning projected benefit obligation at January 1st, 08 is $4,008,000, and the rate the actuary used to calculate that present value amount was 9%. So therefore, we take 9% of $4,008,000 and that is $432,000, and we increased the net pension expense by that $432,000 to provide interest on the projected benefit obligation. All right? So therefore, so far we have two components of pension expense. They are the service cost. By the way, that's what we're giving credit to our employees for working for this year. All right? And once again, the actuary calculates it, and it is based on future salary levels. And then we have the interest on the projected benefit obligation. Now, once again, what's the projected benefit obligation? It's an actuarial account. And theoretically, if we took the present value of all future benefits that we would have to pay you for your pension based on future salary levels, all right, we took the present value today, that would be the beginning PBO. And we know the beginning PBO increases. The PBO increases due to the passage of time by the interest component. So to get the interest component for the current year, we take the beginning PBO times the settlement rate or the discount rate, and that's the interest component. All right, now, the third component, actual return on plan assets. Now, in the books, it says that could decrease or possibly increase pension expense. Now, a lot of times, most times, what it'll do is it'll decrease pension expense. Now, actual return on plan assets, all right, we saw the term expected return. Now, please remember, we do not know our actual return until the end of the year. But during the year, what we're going to do here is we have to take into account some type of expected return that we're going to get on the pension assets during the year. Now, normally on the exam, they'll give you the actual return on plan assets, and they won't mention anything about the expected return. And the reason is because of this. The actual and the expected return were exactly the same. All right? Now that's an actuarial miracle. All right? There is no way that you can actually say, hey, I expect to have a return this year of $100,000. Then at the end of the year, I calculate the actual return, and it's $100,000. All right? That would be, you need really a crystal ball. But if they just give you the actual return on plan assets, all right, and the actual return has gone up, it's going to reduce pension expense. Now, you have to know how to calculate actual return, all right? Just like you have to know how to calculate interest component. Now, let's take it. We take the beginning fair market value of our assets. So you have to look for the beginning fair market value at the beginning of 08. I think we're doing 08 here. Let's assume it's 08. Now, to that, we're going to add any employer contributions. All right, now, we're going to subtract from that any benefits that were paid out. And now will give me an amount. All right, now, we're going to compare that amount to the ending fair market value of the assets. Now, if we come up with an amount here, and the ending fair market value of the assets is greater than this amount, then the assets went up in value, and you have an actual return on plan assets. Now, let's look at the example in the book, and I think it will make more sense. Compute the actual return on plan assets, a component of net pension expense. If the fair value of the plan assets was, all right, $3,000,001 at the beginning of the year. All right, so let's put the numbers here. It's $3,000,001 at the beginning of the year. Now, it says here, at the end of the year, all right, the fair market value of the assets is $3,820,000. All right, so let's put in here $3,820,000. Now, the next thing, it says to us, the employer sponsor contributed $450,000 to the plan. So the employer contributions are $450,000. And it tells us that the benefits that were paid out were $200,000. All right, so let's do a little math here. All right, we take the $3,000,001 and we add to that the $450, and we subtract the $200,000, giving us $3,350,000. Now, notice our ending fair market value is $3,820,000. So therefore, if this $3,350,000, all right, goes up, which it did, it went up to $3,820,000 by the end of the year, that is called an actual return on assets. Now let's subtract it here. All right, we subtract the $3,350,000 minus the $3,820,000, and we have an actual return of $470,000. Now, this actual return, because it increased, all right, it's a return, it reduces pension expense. All right, so let's see what the answer says here in this example. The net pension expense is decreased by $470,000, so it came up here, all right, due to the actual earned on the fair market value of the assets. Now, what happens if we had here $3,350,000 and the actual return, the ending fair market value of the assets was $3,250,000. Now, notice the asset value went down by $100,000. So this is not actually an actual return, all right? This is an actuarial loss, all right? And what we will do here is this $100,000, all right, would now increase the pension expense, all right? So please remember, actual return can either increase, all right, the pension expense if it goes down. See, it went down here, this figure, all right, compared to the ending fair market value. The ending fair market value went down, all right. That would do what? That would be like an expense. That would increase pension expense. But if the actual return is a positive number, then what does it do to pension expense? It decreases it. All right. Now, look at the last paragraph right before it says prior service cost. It says, although the actual return, all right, underline this stuff, although the actual return on plan assets is measured and disclosed as one of the components of net pension expense, right, net pension expense will include only an amount equal to the expected return on plan assets. All right. So therefore, what they're saying is this. All right. When it comes to showing the actual return, all right, please note, all right, you must do what? You have to disclose it as one of the components of pension expense. However, the pension expense will include only an amount equal to the expected return on plan assets. So, all right, let's assume that you have, all right, an expected return of, let's go back to the original amount here. All right, I think the actual return came out to what, 470,000? Now let's assume that, all right, the expected return is 450,000. All right, when you reduce pension expense, you will never reduce the pension expense by more than the expected return. All right, so you calculate the actual return, all right, then you'll calculate the expected return, which is very simple. How do you get the expected return? You take the beginning fair market value of the assets. All right, the beginning of the year, they'll tell you the expected return. Let's assume it's 10%. All right, whatever this is, it comes down to 450. All right, now we came up with an actual return of 470. According to FASB 158, what does it say here? It says that, all right, the net pension expense will include only an amount equal to the expected return on plan assets. All right, so therefore, you never decrease it by what? It's the lesser of the expected return or the actual return. All right, now, all right, let's go to letter D, prior service cost. Now, prior service cost is an actuarial account. And, all right, it can be caused by one of two things. Now, let's assume we have this scenario. we start our company starts on 1/1 of '02. Now, on January 1st of '06, we started a pension plan, a defined benefit pension plan. Now, we have a decision here. All right, we can start the period that everyone is in the pension plan as of 1/1/06, or we can go back and say what? We'll give employees who are presently working with us as of 1/1/06 credit for their past years of service. Now, they started working on 1/1/02. All right. So therefore, if we give them credit towards their pension benefits for these 4 years, that is called an unrecognized prior service cost. Now, the actuary has to calculate what this cost is. All right? So the actuary comes back and he says, well, if you look at it as though you started the plan on 1/1/02 instead of 1/1/06, you're not starting the plan on 1/1/02. You're just giving credit to your employees for past years of service. All right? What do you got to do with this? Let's assume it's $100,000. Now, the actuary, all right, is going to figure out what is the average remaining service lives of employees, which means that, all right, on an average, how many years will it be until our employees start retiring? All right? Now let's assume that's 10 years. And they'll give you that. Average remaining service lives. They'll give you that in the question. So what you do is you take this 10 years, divide it by the unrecognized prior service cost, and that's $10,000 a year. All right? What you'll do is you'll add $10,000 a year to your pension expense. All right? So that's one thing that the unrecognized prior service column that's one thing the unrecognized prior service cost comes from, all right? Giving credit for past years of service. Now, let's take another scenario. All right, now, we started the pension plan on 1/1 of '02. Now, on 1/1 of '06, to be competitive, all right, we amended the plan. Now, when we started the plan, the age of retirement was 70 years old. Now, when we amend the plan, the age of retirement, all right, is now 65 years old. So therefore, employees will start retiring earlier, all right, than we originally thought because we amended the plan. Now, that means that employees are going to start taking money out earlier, and there's going to be an additional cost that we're going to have to start adding to our future pension expense, right? Because we amended the plan and made it better for the employees, but worse for us. All right. Now we go to the actuary and say, all right, what's the cost for amending this age on the pension plan? The actuary says $100,000. All right, so we amended the plan. The amendment's going to cost us $100,000. Now, what do you do with this $100,000? All right, do you add it all to our pension expense during '06? No. All right, what you do is you amortize it once again over the average remaining service lives of employees. All right, let's assume it's 10 years. That's $10,000 a year. Now, what does that mean? From '06 into the future, it's prospective. All right, we're going to add pension expense another $10,000. All right, so please know, prior service cost, which is, by the way, an actuarial account, all right, is due to one of two things: giving credit to employees for past years of service, or giving employees increased pension benefits because you amended the plan. All right, now, the last thing, letter E on page 397, all right, it says gains or losses, increase or decrease. All right, now, normally, this could be an actuarial gain or loss. All right, let's assume the pension plan did better this year than we expected. All right, that's an actuarial gain. Actuarial gains reduce pension expense, where if the plan did worse, that's an actuarial loss that would increase pension expense. All right, these once again are actuary accounts. Now, let's go to page 400. All right, and I want to show you a problem, all right, that's in the book. Now, it's not that complicated. All right, I'm going to give you the flow of the problem. Just keep up with me. That's all I ask. All right, now, all right, what it does is it says in the requirement on page 400, prepare a supporting schedule to determine the amount to be reported as pension expense for 08-09. The company is expected to use the expected future years of service method to amortize the effects of the amendment. All right. So what they're saying is, if there's any amendments to the plan, they can amortize it over, all right, the average remaining service lives of employees. Now, please, all right, what I tell you. Please accept what I tell you. All right. Now, let's assume they tell you what your pension expense is. All right, and they give you the components of the pension expense at December 31st, 08. In fact, the entries they're going to ask you to make, if they ask you, will be at the end of 08. Now, they tell you that the service cost at the end of 08 is $117,000. The interest on the PBO, which increases pension expense, is $49,500. All right. Now, the actual loss or return is $70,000. Now, it must be an actuarial loss because it does what? It increases pension expense. Now, don't worry about this deferral of gain. All right? Don't worry about it. Chances of getting it are nil. All right? Which means nada, nothing. All right? Now, notice, do you always have to have all the components of pension expense? No. All right? Pension expense can be made of 2 or 3, 4. All right? I think it's a maximum of what? 5. All right? But here we have the components of pension expense for the year of 08. Now, our net periodic benefit cost or our pension expense is $130,500. Now, let me show you. All right? Let me show you exactly, all right, where they get the information, all right, for these calculations. All right? Now, on page 399, all right, they gave us on the bottom, all right, the information, all right, so we could come up with the service cost. Now let me show you. All right, go to the information on the bottom, page 399. All right, and let's look at the end of December 31st, 08. All right, now please remember this. January 1st, 09 is not December 31st, 08. We calculate this pension expense at the end of the year. Now, where's the service cost to come up with that pension expense? Well, look at the bottom of page 399. See where it says service cost, $117,000? Okay? All right? That's where we came up with $117,000 on page 400. Now, the second one was the interest on the PBO. All right, now, where do we come up with that? All right, well, how do you get the interest component? You take the beginning PBO at the beginning of 08, and you multiply it by the settlement rate. The settlement rate. All right, now, all right, let's look at what we have here. Do we have the PBO on the beginning of 08? If you go to the bottom of page 399, look at the information. Our dates are 1108, 1109, 123109. Then on the bottom, 123108, 123109. All right. Now, we have the beginning PBO at 1108. All right. Now, at 1108, our beginning PBO is, by the way, they'll give you these amounts, $550,000. Now, you're going to multiply this by the discount or settlement rate. The rate that was used to calculate the present value to get this amount. And that is 9%. Right? It's right on the bottom of page 399. You see that? 9%. All right? So you take your calculator, and you got 550, let me clear this, 550,000 times 0.09, and it comes out to $49,500. All right? So if you go back to page 400, which is the calculation of our periodic pension cost, you will see the 49.5. Now, the next thing, all right, the next thing, you have to come up with the actual return on plan assets, all right, the actual return on plan assets. Now, how do you get that actual return? All right, what you do is this. You go to the top of page 400. Go to the top of page 400. All right, now, let's do this. We get our formula. So you got, the hardest thing about this is to find the information in the problem. All right, now you take the beginning fair market value of the assets at 1108. All right, you add employer contributions in 2008. You subtract any benefits paid in 2008, and then you compare that to the ending fair market value at 12/31 of 08. All right, now, where do we get this beginning fair market value of the assets? All right, we go to the top of page 400. All right, and that is giving you right there, plan assets at 1/1. Look at 2008, it's $400,000. So you take $400,000. All right, now, let's see if they give us the employer contributions. All right, do they give us the employer contributions? All right, they say here, less funding contributions for the year. Well, that would be the employer contributions. All right, funding contributions are the employer contributions. So we're going to add to that $125,000. Now, do they give us any benefits paid? All right, the benefits paid are, all right, what are they? Looks like they're zero. Looks like they're zero. All right, so we have $525,000. Now let's get the ending balance at 12/31 of 08. The ending balance is $455,000. How do I get that? It's right on the top of page 400 under the 2008 calculation. All right, so now what happened? All right, we went down. We had our beginning, we had the employer contributions, pay out the benefits, and now we find out that our ending balance went down. So that means that we had a negative return. All right, so 525 minus 455 gives us 70,000. So we had a $70,000 negative return. So if it's a negative return, on page 400, under the calculation of pension expense, all right, what do? All right, we add it to our pension expense. When it's a negative return, we add it. All right, now once again, forget the furrow of gain. All right, we'll accept the figure. They're not going to give it to you in a problem. All right, so we have pension expense of $130,500. Now, there's one more thing you have to search for. Let's look at page 399, the comprehensive illustration. All right, now it says this: Schaefer Company has sponsored a non-contributory, which means the employees make no contributions, this is on page 399, to a defined benefit plan for 100 employees for several years. Within the group of the 100 employees, it is expected that the workers will retire or terminate at the rate of 5% for the next 20 years, starting January 1st, 09. Prior to 09, the cumulative pension expense is recognized in compliance with FASB 87, which exceeded the cumulative contributions by $150,000, resulting in a $150,000 balance sheet liability. So therefore, all right, what it's saying is this: the opening balance for our accrued pension liability on January 1st, 88. All right? Now, let's go down here. All right? If you look on page 399, all right, there is a financial statement account called accrued pension liability. And, all right, the opening balance on January 1st, 08, all right, is $150,000. Please remember that. All right? So therefore, at 1108, we owe our employees $150,000 for pension. Or to put it mildly, all right, anytime you have an accrued pension liability, that means that, all right, your pension expense has been underfunded. Okay? Keep that in mind. All right. It says here, all right, in the information, prior to 09, cumulative pension expense recognized in compliance with FASB 87 exceeded contributions by $150,000, resulting in a balance sheet liability. All right. So prior to 09, they're telling you here the pension expense exceeded the contributions, which means that the pension plan has been underfunded. All right. Now, let's get the requirements to the question. Okay. All right. Now, what they would ask you on the exam is this. Come up with the journal entries for the pension expense, all right, for 08 and 09, okay? All right, they want you to come up with the journal entries at 08 and 09. All right, now, let's do this. All right, now, we're just going to do 2008, all right, which is on page 401, Part B, okay? Now, it says here the journal entries will include 3 entries. Record the pension expense for the period, report the cash paid to fund the plan, and report any pension asset or liability caused by the overfunding or underfunding of the plan. All right. Now, below are the journal entries required for Schaefer for the first 2 entries. All right. Now, we're just going to do 08. Now, first of all right, they debit pension expense $130,500, and they credit accrued pension liability $130,500. All right, now where did they get that? Well, on page 400, we said the pension expense was $130,500. You see that on page 400? So what we're going to do here is, first step, after you calculate your pension expense, make this entry. Debit pension expense. And we're doing this at 12/31 of 08. All right. Our pension expense is $130,500. And what we'll do is, we're on the accrual basis for this. We'll credit accrued pension liability for $130,500. Now, let's see how much of this liability the employer funded. All right. Now, you got to go and find out how much the employer funded. All right. Now, actually, we saw that before, because, all right, when we calculated the actual return, all right, we went to, let me see what the actual return computation is. We went to the top of page 400. And remember, one of the components of actual return is we have to subtract what? All right? All right, we have to add employer contributions. Remember that? Get actual return. We have to take the beginning fair market value assets. We add employer contributions, we subtract benefits paid, and we compare that to the ending fair market value. And we did that calculation from the information on the top of page 400. Now, look at the 2008 year. All right? If you go down to the 5th item, funding contributions for the year were $125,000. That means the employer contributed $125,000. Now, go to page 401, Part B. Right? What's the entry you will make on your books for that? You will debit accrued pension liability for $125,000, and you'll credit cash for $125,000. So what I've done here is this. I showed you how to get the pension expense. I showed you how to come up with the accrual, which is what? Just credit accrued pension liability. All right? Whatever the pension expense is, credit the accrued pension liability. Then find out how much the employer funded of the accrued pension liability. And it was $125,000. Now, under old FASB 87, all right, if you remember, we had a minimum pension liability that we had to calculate. All right, which meant was, all right, there was an item called the accumulated benefit obligation. And what was that accumulated benefit obligation under the old FASB 87? All right, well, supposedly it was, all right, how much we have to pay our employees today if they all cashed out based on current salary levels. And at the end of the year, we would compare our accumulated benefit obligation, and if it exceeded the fair market value of the assets at the end of the year, then the plan was underfunded, and we had to set up that amount as the minimum pension liability. All right? So therefore, under the old FASB 87, all right, we had a minimum pension liability, all right, which was the excess of the ABO over the fair market value of the assets. Now, if the fair market value of the assets were greater than the ABO, we had no minimum pension liability. Now, guess what? Under the new FASB 158, there is no minimum pension liability. All right? It is based on over or underfunding of the pension expense. So therefore, this is the next step under FASB 158. What we do is this. We get the ending projected benefit obligation at 12/31/08. All right? And let me make this a little smaller here. We get the ending PBO at 12/31/08. All right? And we compare it to the fair market value of the assets at 12/31/08. Now, we're going to adjust this accrued pension liability, all right, to equal the over or under funding amount. Now, let's look and see what we have in the accrued pension liability account for 2008. Well, to refresh your memory, all right, we had an opening balance, remember I showed you that, of $150,000. There was an opening balance, all right, because, all right, from FASB 87 coming over to 1109, they had an accrued liability, which means that their expense was underfunded as of 1108 by $150,000. Now, for 12/31/08, what did we do? We credited the liability for $130,500, and then we paid at 12/31/08 $125,000. $125,000. Does that come out? Can you see that 125? All right. Now let's get the balance in this account. All right. We have $150,000 opening balance. All right. We added to that $130,500, and we're going to subtract $125,000. All right. So that equals a balance in the account of $155,500. Right? Now that's what we're showing is in the accrued liability. However, we have to go by what the actuary thinks that the pension plan is under or overfunded by. Right? And now, under the new FASB 158, the way you determine that is you compare now the PBO at the end of the year to the fair market value of assets at the end of the year. All right? Now, let's do that. Now, first of all, we go to, all right, our information on page 399. Now, on page 399 on the bottom, look at 12/31/08, because remember, we're comparing the ending PBO at 12/31/08 to the fair market value assets at 12/31/08. Now, if we look at the information at 12/31/08 on the bottom of page 399, all right, Do we have the PBO? No, but we do have the what? Fair market value of the assets at the end of 12/31/08. That's the third item. And how much is that? That is $455,000. Now, we still have to search for the ending PBO. All right? Now, you have to search the information. It's just not in any specific order. I don't see anything on page 400. All right? But I go to page 401, and, all right, I look where it says Part B. There's my journal entries. And then the second paragraph says, FASB 158 requires that the balance sheet reflect the funded status of the plan. The status is determined by comparing the PBO to the fair value of the plan assets. The end of the year PBO is calculated as shown below. All right. Now, I will show you in a second how you calculate the ending PBO. But, all right, they give it to you here. All right. And what's the ending PBO at the end of the year? And the answer is, all right, at 12/31/08, it's $716,500. Now, these are all actuarial accounts. All right. Now, the actuary says, hey, if everyone cashed in today at 12/31/08, all right, based on current salary levels, based on future salary levels, we owe them $716,500. But we only have assets valued at $455. So as far as we're concerned, the actuary is saying the plan is underfunded by, let's take the difference here, $716,500 minus $455,000 is $261,500. So that's what the accrued liability should be. Now, how much is our accrued liability? All right, just by looking at the beginning balance of what was in $150,000, adding our first journal entry to it, a credit of $130,500, and then, all right, showing our entry for the payment of the liability for the 12/31/08 period of $125,000, we come up with a balance of $155,500. Now, that's the ending balance per the company. All right, here is the ending balance per the actuary. All right, so therefore, what we have to do is, all right, we have to bring our ending liability up to what the actuary says it should be. All right. So what we do is we subtract $261,500 from $155,500, and we get $106,000. So what we have to do is we have to increase our liability by $106,000. All right. Now, what's the journal entry we will make to do that? All right. Well, we go to the top of page 402. All right. Now, look at the first entry, which is made at the end of the year. All right. Now, remember, we have to increase our liability by $106. So, on the books, we credit accrued pension cost, which is the accrued pension liability of $106. Now, when we set up a liability, what does that do? By increasing the liability to the accrued pension liability, all right, we are saying, by setting up an additional liability, that now, by setting up that liability, the equity of our corporation, all right, will be reduced. Now, we used to, all right, under the old FASB 87, debit an item called deferred pension cost, blah, 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 all right, and it had a limit on it. Forget that old rule, all right. Now what we do is this. We say that if our pension is underfunded and we have to add an additional liability of $106, the way it reduces our equity is by going to a debit to the other comprehensive income account. Now, what's the definition of other comprehensive income? This is the reduction of equity due to an entry other than that in which we're dealing with the stockholders. Now, are we dealing with the stockholders here? And the answer is no. Right? We're dealing with the employees. Right? So therefore, what we do under the new pension, FASB 158, right, we credit accrued pension liability, 106, and we debit other comprehensive income, right, which is a stockholders' equity account, right, and because we're setting up a liability, it will reduce other comprehensive income. Now, FASB 158 says we have to show other comprehensive income net of tax. So what we do is we take the 40% of the 106, and that is $42,400. All right. So what we're going to do is this: we're going to credit other comprehensive income. Don't worry about deferred tax asset. All right. Credit other comprehensive income, $42,400, and debit. Here's the plug: deferred tax asset. All right. Now, why is this a deferred tax asset? Because by debiting other comprehensive income and setting up an accrued pension liability, we are saying that this is going to be a future deductible amount. And when it's a future deductible amount, all right, according to accounting for income taxes, all right, that sets up a deferred tax asset. All right, future deductions give us money that's going to be paid to us back from the government in the future. All right. Now, therefore, in the stockholders' equity section of the balance sheet, we will show other comprehensive income of 106 minus 42.4, which has a net debit balance. All right, so it reduces the equity by that amount. Okay, all right. Now, what you then do is this. All right. How many minutes? What do we have left? We have 8 minutes left. Okay. Now, let's assume that the plan was the opposite. Okay. Let's assume that the ending PBO all right, let's assume the ending PBO was $500,000. And the fair market value of the assets were $725,000. Now, in this case, what happens is, all right, according to the actuary, the plan would be overfunded. And the overfunded amount would be $225,000. Now, what would we do if the plan is overfunded? All right. Well, what we have to do is this. All right. We would have to show the 155, which we're saying is underfunded, and make it, all right, which is underfunded. We would have to make it overfunded. All right. Now, how would we do this? All right. First of all, we have to end up with a prepaid pension cost of $225. All right. We got to come up with $225. All right. So this is what we do. All right. We will debit prepaid pension cost of $225. Now, we're going to have to get rid of this account. So what we'll do is we'll debit accrued pension liability of $155,500. All right, and what we'll do is we'll credit other comprehensive income for, let me add this up, all right, this will end up being, all right, a credit of $380,500. All right, now, what do we do here? All right, if the pension plan is overfunded, all right, according to the actuary, all right, first of all, we have to get rid of the amount that's underfunded. All right, so we debit that accrued pension liability for $155,500. Now, we have to show that the pension plan is overfunded. The way we show that is by setting up an account called prepaid pension expense, prepaid pension cost. All right, now, debit that. Now we're saying we are overfunded by $225. And the plug entry goes to other comprehensive income. Now, the next thing we're going to do is this. we have to show other comprehensive income net of tax. All right? So therefore, let's do this. Let's erase this. And let's assume the tax rate is 40%. All right? So what we'll do is we'll debit other comprehensive income, all right, by 40% of this $380,500. And that's $152,200. And what we'll do is we'll credit deferred tax liability for $152,200. Now, why are we doing that? Well, first of all, if our plan is overfunded, all right, then what happened? All right, what happened was, all right, this. We have to do this. The minute the plan goes from underfunding to overfunding, the equity of the corporation went up. All right, if we were underfunded by $155,500, all right, and now we're overfunded according to the actuary, all right, FASB 158 says that we have to show both under and overfunding. All right, so what we do is, all right, we have to get rid of that liability, which we did, and now to show the amount that's overfunded, debit prepaid pension of $225, all right, and credit other comprehensive income, all right, for $380,500. So by overfunding, all right, what does it do? It increased our equity. Now this is an increase in equity, all right, other than from dealing with stockholders. So we credit other comprehensive income for that amount. Now, take the rate, the tax rate, multiply it by this $380,500, debit OCI, and credit deferred tax liability. Because what is this? All right, if it's going to increase stockholders' equity, it's considered future taxable amount. All right, and all right, a future taxable amount times theoretically a future tax rate gives us a deferred tax liability. Okay? All right, now, if they would ask this on the exam, my guess would be this. They wouldn't ask for the overfunding example, they would ask for the underfunding example. Okay? All right? Now, play this over again if you don't understand it. Now, we're not done with it. All right? What we're going to do is, in the next class, all right, I want to go over with you, first of all right, I want to go over some multiple choice with you to clarify this. And I think once you see the multiple choice, all right, it'll all come together. All right? In fact, I know it will all come together. Okay? All right, we'll see you for part 2 of pensions. Thank you.